Boom. All right, cool. So selling puts. I don't have any like presentation for it or anything, but it will help me out if you guys ask questions. The reason selling puts is so great and it's way better for most people in the group right now. They're trying to make a modest return. So they're trying to make 10%, 20%. To do that, selling puts is way less risky than buying calls. Buying calls, if you just want to buy a call and just ride with it, it's a huge risk to try to get a huge return usually, especially when you're doing something, playing with stuff like Tesla and a lot of the SPAC plays. Like it's a huge risk to try and get a huge return. So selling puts is 10 times better because when you sell a put, you benefit in a multitude of ways. One, you're going to benefit if the stock goes up. So I'm pull up Robinhood actually. Let me share this because I know a lot of people use Robinhood and I actually do like their interface. Boom, somebody's messaging me. Okay. Sorry, Justin. Justin, do your best. All right. All right. So I wouldn't sell a put for IPOE. Let's pick something a little bit better. So for weeklies, I like to sell Palantir puts. So go down here, trade Palantir options. Go instead of buy, hit sell, boom, and then here, put, right? So what you want to do when you're selling puts is you want to pick a stock that you, Justin's getting back in, boom, all right? When you're selling puts, you want to pick a stock that you wouldn't mind owning because as a couple guys in the group found out, when you sell a put, you can get exercised on that very quickly. So I don't mind owning Palantir. I think that it's going to go up long term. So if I just want to sell weekly puts right around the money, I could sell this 24 put, boom, and it'd give me a credit of 82 bucks, okay? Now, if I wanted to limit my risk because maybe it was really volatile, I was afraid it was going to go down below 20, you know, you never know what's going to happen. I could also buy a put and it kind of serves as like your stop loss. So when you're selling a put, you're selling someone else the right to sell you those shares. All you're doing is essentially putting in a buy order that you're getting paid to put in at that price. So for example, if I wanted to buy Palantir, instead of paying $24.15 for the shares, I would rather pay 24 or 23. So I can sell someone else the right to sell it to me at 23 because they just want that peace of mind to be able to sell those shares for that, or they believe it's going down below that, right? So you sell somebody else the put who's bearish on it and believes it's going to go below 23. And then if it does, oh, well, you got to buy the shares that you were okay with buying anyways. So it's kind of a win-win on either end. And that's how the option wheel starts is you can sell puts. And then if you're exercised on that put, then you sell the calls off of it. So take Palantir, for example, really quick. Let's just say, get this off here. Let's just say that we got exercised. Let's say Palantir falls to $22 and we get exercised on a $24 call. Now we own 100 shares of Palantir at an average $24 per share. We can go out a couple weeks. Let's go to the 30th. And we can sell a call because now we can sell covered calls on the shares that we own. And we could sell a covered call for $25. Now we're going to make that $100 premium right off the bat, 107 bucks, boom. Okay. And then if Palantir stays below $25 and April 30th comes, cool. We made the $100 premium. We still own the shares. We can go to the next week out, go 2 more weeks out, 3 more weeks out, a month out, and sell another 25. Boom. Make another couple $100 bucks. Does that make sense to everybody so far?
Yeah, that makes sense.
Does anybody want me to like go through with them where they're on their screen where I can see you guys doing it and you can ask me questions? Am I doing this right? Am I doing that right?
I have a question. For less risk, would you rather do, I know this is different, but is it better to do the spreads that you were talking about, like a call spread, or is it better to sell these puts?
That's a good question. And it's kind of on a case by case basis. So there's
Okay.
certain tickers and certain stocks that's better to sell puts on, and there's certain stocks that I would rather do call spreads on. Both are bullish positions, so both are saying that I believe the stock is going to go up. But for the returns that you guys are talking about wanting to make, the options wheel is going to be gold for you, and you don't necessarily, you want to do it with some less volatile stocks, so they're not going to be as risky, and you're not going to necessarily need to use spreads. You can, but you don't have to. So Palantir, for example, and then let's just say the call gets exercised. Let's say one day it goes up to $26, and then my call gets exercised. Now I get paid $2,500 for the shares that I only paid $2,400 for, or yeah, $2,500 for the shares I paid $2,400 for. So I made $100 just on buying and selling the shares. Also, I made $100 from the premium of selling the put, and then I also made $100 from the premium of selling the calls. So that's why the options wheel is so profitable, because you're making money on every end. Does that make sense, everybody?
That definitely makes sense. How can you screw yourself with an option wheel?
You can only screw yourself as bad as it is buying stocks. You know what I'm saying?
Okay.
This is why I tell people that there are ways to make options less risky than stocks. For example, if I own 100 shares of Palantir and I just bought them right now to own them, I would pay $2,400 or $2,415, right?
Right.
But if I put in, if I sell a put, instead of putting in the buy order, I get paid for the exact same thing.
I see. So you're making $100 or whatever, $177, doing the same exact thing you would have done if you wanted to buy those 100 shares straight up.
Exactly.
And you could turn around and say, if you really don't want those shares, you could flip them real quick and just get rid of them.
Yep. Or you could run calls on them and then make money by selling covered calls.
Okay.
So what makes it the put get exercised besides like expiration date?
Great question. If it goes below the strike price. But I mean, that rarely happens. That almost never happens.
The put you bought or the put you sold?
The one you sold.
The put you bought, right? Okay.
No, the one you sold. So if I sell a $24 put and I sell the May 14th $24 put, I take $200, and here comes May 14th, and Palantir's at $22. Then they will exercise that put, and I will have to buy 100 shares for $24. So that's the biggest risk right there, is you may have to buy shares.
And you own the stock that's worth $22 instead of 24.
Exactly. So you would have lost.
But you could wait for it to go back up or sell the call.
Exactly. Yes.
Case in point, Pinterest. But does that lock you into keeping those shares while you're selling those puts?
Not when you're selling the puts. When you're selling the covered calls, it does.
Okay. Gotcha.
So if I got exercised on the put, I had to buy them. Then I sold $25 calls on Palantir right here, just because it's on the screen. I have to hold on to those shares because I have to be able to sell them if that call gets exercised. That's how it's covered.
Okay.
So it can require a little bit more investment. And I know, Justin, you were nervous about putting in the put spread, the credit spread that I alerted, because it was the PayPal credit spread, which printed money, by the way.
But it was a lot of money tied up, which is what made me
high. Remember?
Mm-hmm.
So let me pull up PayPal. And let me look what that was. Do you remember what that was by any chance?
Which one it was?
Yeah.
I think it was a 240 something.
Yeah, I think
243.
I think I sold. So it was back when PayPal was 250 or so. And so I think I sold. I was expecting to run up, the earnings was coming. See, I sold
Because the 230, 250 was the one that I sent you on Facebook.
Okay, then that was probably it. So I sold the 250 for like 1,500 bucks for May 21st as well. So I sold the 250 for like 1,500 bucks. And so if I wanted to do that right now, I would click here. And then I bought the 230 for like 500 bucks. No, it was like 700 bucks. So I got a $700 credit. So if I was just running, let's just run it today like it's today, okay? Because I still believe in this play. I did cash in on it because I was up enough, but if I sold the 250 put, okay, I would make $665. But then if PayPal goes down to $200, I'm screwed. I would lose $5,000, which I don't want to risk, right?
Mm-hmm.
So what I do is this 230 put is almost like a stop loss for me in saying that I can't lose more than $2,000 with this, because if it drops below 230, I sold somebody else the right to sell it to me for $250. But I have the right to sell it for $230. So worst case scenario, both of those rights need to be exercised.
So you're losing the difference between the two.
Exactly. So that's where you saw that the risk level was that much. You saw like you're risking, like I think for this play it was like 1,300 bucks, or maybe it was 2,000 bucks. It would say risk. The reason your risk really isn't 2,000 bucks though is because you're going to get this premium right here regardless. And so that's why it's 1,600 bucks for this trade right here. So you would risk 1,600 bucks would be the worst case scenario, because that's the difference between the two strikes minus the premium that you already collected. Make sense?
Okay. Yeah.
The reason this is less risky than buy, so let's just say you thought, if you think PayPal is going up, now you could also just buy a call, right? So let's just see how much a call costs that's at the money, because we were selling these close to the money then. So let's go buy a call. So to buy a call, you're risking, if you're going in the money, you're risking 1,800, 1,700 bucks just to buy this call. And if PayPal goes down a little bit, you lose all 1,700 bucks. It expires worthless, right?
Mm-hmm.
But if you sell the put and PayPal goes down a little bit, maybe it goes down to 259, 250 even, you still only lose $1,000, but you would have collected over $1,000 premium and it'd still be a profitable trade. That's why there's less risk doing it like this than just buying a call.
So do you let them run to expiration, or when do you close? I mean, or how do you close them out?
That's a good question. So with this trade specifically, this was getting paid off of the implied volatility on the run up to earnings, and then expecting an IV crush after that. And so your premiums on the run up to earnings, because of implied volatility, go way up. They're really expensive. So that's when you really want to sell options and make all that money. And then the second they announce earnings, they go to, it's called IV crush, because implied volatility goes to like nothing. It disappears overnight. And that's where you make all your money selling an option like this. So with that, I would have waited till right after earnings, especially if it goes up for earnings. These bad boys would be close to worthless, but I already cashed in on this one because I had made a nice chunk, so I was fine with it. Make sense?
Yeah. And it's just the same as closing a normal call spread. You just go in and hit close.
Okay. I'm so glad you asked that, because I keep getting asked this question. And so to close out option that you sold, so let's say I sold this put here, and it'll say sell, one sell, and I put that you sell. And then let's say that PayPal goes up to 300 this week. And so this put is worth $2 now. And I'm like, okay, I made 80%, I'll just buy it back. So the way you close this out is by buying it back. And you can do that when you do credit spreads. So if I would have sold this put, and let's say, remember how we buy the other put as kind of like a stop loss to Also, it's not just a stop loss, but this way you don't have to put up as much cash.
Money right away. Yeah.
Yeah, you don't have to cover it with, like, it's cash secured put. If it's just the put, you'd have to have $2,600 just to sell this put, because you have to be, or 26,000, 2,600, because you have to be able to buy
100
100
shares.
shares for $260. Make sense? So it's actually, yeah, you need $26,000 to be able to sell this put. All right, so that's like a cash secured put. If you're selling on margin, it's naked put. Either way, I would do that with lower cost stocks with a smaller account, but you could still run the put credit spreads with this size accounts. Now, the only bad thing that'll happen, or that could happen, is if it expires in between the two strikes. So let's say you sold the 260 and you bought the 250 and it's 255 at expiration. In that case, you're going to have to buy those shares for 260, even though they're 255. But it's actually better than it going below this, because you can just sell them right away. It's not like you have to hold them for a certain period of time or anything. Oftentimes, if you're doing it as like naked puts or anything, you'll get a margin call and you'll have to sell them right away. Some brokers will even do it for you.
But you don't usually wait till the expiration anyway, right? You sell it for the premium.
Right. Yeah, definitely. Once it's totally crushed, there's no point if you've made 90% back. So that's a big difference though with these, is you're never going to make over 100% because it's a credit. Well, the only way you would make over 100% is if it went so low below the put that you bought as well, that was more than the difference in the strikes. But that's very rare. I don't think I've ever had that. Anybody have any questions?
So this is I'm really understanding what you're saying now. But like, for instance, PayPal had a great week. Like, I'll even use like Daniel, as I know he's not on the call, but use him as an example with the SQ. Like, I'm sitting there on the sideline watching it all week. And it's just like, damn, you could kill it with the calls because you can make unlimited percent. Now, if you were to do like a spread that we were talking about,
Sure.
you can only make it is 100%, right? So you can only double your money. Best case scenario.
No, when I'm talking about the credit spread, the reason you can only make 100% is because you get paid right away. So even if you're selling, it is going to give you this $1,028. And if I sold this put, I get paid right away. So the most I make is what I sold it for. I can't make any more than that.
Makes sense.
The other thing with like the credit spreads, or with the debit spreads rather, that we were doing for call options, that this makes you guys, honestly, with the goals that you guys have, I would not be just buying calls. I would be buying and selling calls. I would sell calls on any call that I bought. I wouldn't just buy them. All right. So if I was wanting to get in PayPal, I would probably buy 270 here, maybe, if I thought it was going to rock it, and I might sell. If you want to go here, let's see what that is. Boom. So for $400, you can make 1,000. Usually, if you think about it like this, when you're putting together a spread, think about it like, if now there's other ways you could do it too, to see what the most profitable way to run spreads is. If you go on E-Trade, they have all types of options, calculators and things that you can use. But the way I like to think about it, to keep it really simple without getting into the Greeks and everything, to just really simple, is what if I just bought the call? So if I bought the 270 call, when would I sell it? What would my sell target be, right? So if my sell target is 280, and I would establish that usually by looking at the charts, checking out where the resistance is, where it's been bouncing off of, knowing when earnings are and different things, maybe if there's news, whatever. If I was going to sell this, what would I be happy selling it for? What would my target sales price be? So if it gets to 280 and I was trying to, get $1,000 to get 100% return out of it. Let's say my goal on this trade is 100% return. Well, I know I'm going to make over 100%. I could probably go even a little bit safer. I'd go a little bit deeper in the money. So you could go, if I just wanted to make 100%, let's see, I could sell this baby and buy This baby. Boom. Now I make 100% return on that one because it's $500 to buy this spread, and it's $1,000 if it goes over 270. But the beauty in this is the intrinsic value. So you see, it's already at 266.58. So you're getting $658 worth of intrinsic value that's already there. The call you're selling has no intrinsic value. It's all extrinsic value. Does everybody understand that concept?
Can you explain that real quick, just like in simple terms?
I'll try. So when you're buying an out of the money call, it's completely worthless if it expired today. So that
Right.
270 call, if it's May 21st today, it's worthless. But this 260 call, if it's May 21st today, is not worthless. It's worth $658. So like if this spread was expiring tomorrow, it'd be gold because you'd make yourself a couple $100 really quick, right? So, but it's not. But just assuming that it was, the value that's in it right now, there's $658 in this call that I'm buying, and they're intrinsic, and there is $0 right now in a 270 call intrinsic. Does that make sense?
Yes.
Awesome. Okay, let's see what else I got for you. Does anybody have any questions, anything they want to go over? Does everybody feel comfortable buying spreads, credit spreads, debit spreads, selling puts, option wheels? Any questions? Everybody comfortable? What do we got?
No, I know that this week I'm gonna have to put some money into Robinhood because it just seems so much easier. Like just watching you do it. Like when I was trying to do it on Fidelity, they make you break down a leg and then they ask you all these questions and shit. And I'm like, okay, I know I'm going to click the wrong thing and get screwed. But looks like on Robinhood, it is just so self-explanatory.
Yeah.
So yeah,
that's why I like it. The interface is seamless. While Daniel was
right.
But yeah, the interface is super easy. I like showing people on Robinhood too. Also, just if you want to know a little bit more about the option, you can click on it real easily and see the Greeks. Very simple. Implied volatility, very simple. Where it closed at previously, the highs, all this data are real quick and easy just with a click. Yeah, I definitely like Robinhood's interface. I can't help it, even though I hate Robinhood.
So with credit put spreads, you're looking for a stock that's not super volatile, but you think is going to go up, right?
To be safe, yes. But if you're being that safe, you might not even need it to be a spread. You could probably just sell the put.
Okay.
If you're looking to make the most money, you want to sell on more volatile stocks because that's where the premiums are highest.
So so you would want to do like say Apple because it's going to go up just very slowly, but like you don't want to mess with that. With
premiums are trash though.
Oh, they are. Okay.
Apple anything, just buy it. If the premiums are way too low, I don't know why. Trying to see what else I have for you guys. Selling covered calls. Any questions on that? Does everybody understand that? Because a couple people got exercised on puts they sold recently. So does everybody understand that concept?
Yeah.
Justin, I know you're going in and out of reception areas, but do you have any questions about anything? Because I know you were kind of hesitant this week to enter some of those trades. I want to make sure you're feeling good this week.
I think it makes a little more sense. While we were driving on Saturday, I was looking up just like explanations on selling puts and credit and that stuff too. And that helped like clarify it a little bit, just looking at graph.
Cool.
So,
awesome.
But I think that answered all of it as far as just have to find one, actually do it.
Yeah, so I usually post like 1 or 2 of those a week. Now, when I'm personally entering credit spreads, those are usually the spreads that you see are my largest trades. So, and they're usually yellow or green risk level. So like the ones that you see that are like red, I was telling Jeff earlier that those are just like the dumpster divers that I was telling you guys about, where they're super cheap and super risky. And I'm just getting them as kind of like YOLO calls. But when you see the spreads that I'm entering, those I'm putting like 5 to 10 grand in, whereas the YOLO calls I'm putting like 100 to 500 in. So that's the difference of my like investment level and how much I'm committing to them.
So the spreads are what you feel more comfortable and confident that they're going to do well.
I don't know if that's the best way to put it. They're the safest. They're the ones that I feel I know. They're the ones I have the most confidence in doing good, but not necessarily doing the best.
Okay.
I'll have, honestly, my dumpster diving, you know, right now you can get SPACs that haven't announced an acquisition yet that are sitting at $10.05 for $5 a call. It's 100% intrinsic value. And every dollar they go up, you're riding it with it. It's just like owning 100 shares, but you don't have to pay anything but $5. Anybody who owns 100 shares had to pay $1,000. So those plays right now, a couple, BTWN, they announced Tokopedia, they announced their merger, and it went from, you know, 10.50 to 12.50 really quick. And I paid 50 cents for the calls and I sold them for $2.50. And so I made, you know, 500% on that really quick. So my goal with those is like 500%. My goal with my spreads is usually like 100% ish. Depends on the spread.
Okay.
But way safer, way safer. Any other questions? Anything I can do for anybody? Does anybody want to try and enter one with me or be on a call with me or need anything else from me to feel confident with this?
I think I'm good. I'm just going to go on to Robinhood next week.
Awesome. Feel free to reach out with any questions or any specific plays that you're going to enter to make sure you're doing it right. I know Jeff reached out a couple times throughout the week trying different things out. So don't be afraid to try it out. You can always do it with cheaper stocks too. Like I said, like Palantir is not as expensive. Workhorse, there's some other really cheap stocks that you can just play with, and it's not as risky because they're cheap.
Is it better to sell a put a month or so out, or is it
Compare as opposed to what?
Well, as opposed to like weekly, or is it?
So most of the premium evaporates in the last week, but really in the last 3 weeks too. So I like to sell them about 3 weeks out. It depends on the play too. So like if you're playing earnings, you want to look at when earnings are, and then you want to play the IV of earnings and play the IV crush after.
Okay.
Are you going to be playing any earnings like calls coming up that you feel pretty confident in?
That was the PayPal credit spread that I shared.
Okay.
Last week. That's my earnings play right now. And it's not,
okay.
So the earnings that I'm playing right now is like the run up to earnings, because a lot of the earnings are coming in like 4 weeks.
Okay. Sounds good.
All right, guys, feel free to reach out
Awesome.
if you need any help with all this stuff. I'm gonna go over the Greeks and everything with you guys probably next, so you can really start feeling this stuff out. But I want to make sure that everybody understands this first. Just, you know, basic buying and selling of calls and puts. All right.
Awesome. Thanks, bro.
Hit me up.
Awesome. Thank you.
Yep. See ya.
All right. See ya.